Hey guys, in this chapter we are going to discuss the nature of capital investment analysis. So let's kind of talk about what capital investment is anyways. So management plans, evaluates, and controls investments in fixed assets, and most of these capital investments are going to require a long-term commitment of funds. So not only a lot of money, but it's going to be perhaps a long period of time before we have everything paid for. Investments must earn a reasonable rate of return. So if we don't think that building a new addition to the factory is going to help us be more profitable, then maybe we shouldn't do it to begin with, right? So we're going to expect that there's going to be a reasonable rate of return on these investments. And lastly, capital investment decisions are some of the most important decisions that management make, and that's because of the 1, 2, and 3 that we see right above there. Okay, so capital investment analysis or capital budgeting is the process by which management plans, evaluates, and controls investments in fixed assets. Now let's talk about 4 methods here that can be used to evaluate capital investment proposals. And the first 2 are listed under this heading that says that they are methods that ignore present values. We'll talk about what present values are in a little bit, but basically it's the time value of money. So would you rather have $1 today or $1 a year from now? Well, the answer should be you'd rather have the dollar today because you could invest that dollar and make interest on it, or invest it in stocks or mutual funds or something that's going to let the money work for us. So we would rather have the money right now instead of later. Okay, so that's the time value of money. And the 2 methods over here that use the present value, those do take into account present value or the time value of money. So the net present value method and the internal rate of return method both are going to incorporate the use of present values. These top 2 here are going to be easier to use, but they're going to be a little less exact, right? So we might use these first 2 as a fast way to screen in a proposal to see if it looks like it's going to work for us or not. And once we get a little more serious about it, then we might take the time to look through these 2 methods here. So we can see here that the net present value method is going to be used 85% of the time by these respondents here reporting to the question with respect to how often they used these methods. Average rate of return method was used the least. Internal rate of return method, now remember these 2 right here incorporate the present value or the time value of money, and these 2 do not. So let's talk about this average rate of return method. And so what this method is it measures the average income as a percent of the average investment. The average rate of return is computed as follows. It's the estimated average annual income divided by the average investment. It's pretty easy, huh? In order to come up with this figure for the average investment, we take the initial cost and we're going to add to that the residual value. And so remember, the residual value is the same thing as the salvage value. It's anything that we're going to be able to get for the item once we are finished using it. So we're going to add those 2 guys together, and then we're going to divide them by 2. So we add this plus this, we divide it by 2, and that gives us the number that we plug in here as our average investment. Okay? So let's take a look here at this proposal. Management is evaluating the purchase of a new machine, and the machine cost is $500,000. We're going to assume that there's no residual value, so once we're through using this thing, it's going to be worth nothing. The estimated total income from the machine is $200,000, and the expected useful life is 4 years. So we're going to get 4 years of usage out of this, and once we're done, it's going to be worth nothing. It's going to cost us $500,000. And it's going to help us generate income of $200,000. I'm sorry, and that's per year, right? Oh, I'm sorry. Looking back at this, it was written kind of confusingly. That's the total amount is $200,000, and it's going to be spread over 4 years. So we're going to have $200,000, and it's going to be divided by 4 years, so we'll be able to get us $50,000 per year, right? The average investment, we simply take that machine cost, we add to it the residual value, which was 0. We're going to divide the total of these 2 by 2, And once we crunch the numbers here, we're going to get 20%. That's our average rate of return. And we're going to compare this with the average rate of return of perhaps other proposals, and we can rank them. And as we rank them, the higher the average rate of return, the better. So the average rate of return of 20% should be compared to the minimum rate of return required by management. If the average exceeds the rate of return, if the average rate of return equals or exceeds the minimum rate, the machine should be purchased or considered for further analysis. So in this case, if the minimum rate of return required by the company, if it was something like 17%, and this 20% would exceed 17%, well, then that means we need to analyze this guy further. So here's the benefits of the average rate of return. It's easy to compute. It includes the entire amount of income earned over the life of the proposal. That was $400,000 in the previous example. But the following two disadvantages here are that it does not directly consider the expected cash flows, right? So when is the cash coming in? Versus just income, we've learned in the previous accounting class that the timing of the receipt of cash can be quite different from the recording of the income. And this does not consider the timing of the expected cash flows either. And also, as we mentioned before, this does not consider the time value of money. So on to the next method, the cash payback method. The basic concept of this is we're looking at how much cash it's going to cost for us to buy the piece of machinery or whatever project we're interested in, and we're going to look and see how long is it going to take for us to be able to recoup the cash that we dumped on this investment. So if the annual net cash flows are equal, such as we're going to receive $10,000 every year for 10 years, that can make everything very easy when we're trying to calculate the cash payback period, because we take the initial cost. So let's say we had a $100,000 cost of a project or a piece of machinery, and we received $10,000 of net cash inflow per year. It's going to take us what? 10 years, and at 10 years we will have recouped the $100,000 that was dumped into this project or was spent on this project. Now, when the annual cash flows are not equal, it's going to be a little more complicated for us, and we're going to have to add the annual net cash inflows until the cumulative total equals the total cost of the proposed investment. So let's just take a look here. Let's assume we're dealing with a proposed investment that has an initial cost of $400,000. Let's see how long is it going to take for us to recoup it. So it costs us $400,000. So what we're going to do here is we're going to look at these. We're going to add these all up until we reach the point where we have $400,000. And at that point, we'll know that it took 4 years for us to recoup the cost of it. So in the first year, we have $60. Second year, we have $80. So 60 plus 80 is $140. The third year, we earned $105. So 60 plus 80 plus $105 equals $245. And in the fourth year, it's $155,000. So 60 plus 80 plus 105 plus 55 equals $400,000. So that's 4 years right here, isn't it? Now, if it happened to be 4.2 years or 4.1 years or 3.9 or 3.8, that's fine too, but we're given simple figures to make this easier to follow here. So basically, we're trying to determine the amount of time that's going to pass before we have brought in enough cash to cover the cost of the investment. Now, two advantages here is that it considers the cash flow. It shows when the funds are available for reinvestment, but it does unfortunately ignore cash flows occurring after the payback period. All we try to do is figure out how long it's going to take us to recover those amounts, and also it does not take into account the time value of money. So that's going to be another downer there or disadvantage of the cash payback method. And once again, this could be used as a quick screening tool to determine if we think an investment is worth us spending more time analyzing it. And it could be used in conjunction with the first method that we discussed here in this video. So earlier I asked the question, would you rather receive $1 today or $1 a year from now? And the answer should hopefully have been that you would rather have a dollar today because you could invest it, right? So let's take a look at an example. Let's say on January 1st, 2010, you're given that dollar and you invest that $1 in an account that earns 12% interest compounded annually. Okay, so earning interest is called compounding. So when we earn interest on that interest, it's called compounding. Compound interest is a pretty cool thing, and Albert Einstein was quoted as saying, "Compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it." He also referred to compound interest as the most powerful force in the universe. So this is some pretty interesting stuff here. So let's take a look at this slide. We can see here on January 1st, 2010, we have a dollar. Okay, let's take a look at what it would be worth so we're in January 2010. So if we took 1 year, 2 year, 3 year. Let's see. In year 1, we have a dollar at 12% interest rate. So 1.112, that is going to give us that's 12% added on to the dollar that already exists there. So 1 times 1.12 gives us 1.12. So we now have $1.12 after that first year, don't we? So that's pretty good. And then here for the second year, we're going to take that $1.12 and multiply it by $1 or 1.12. That's going to give us $1.25. A couple extra there fractions of a cent. We'll multiply that by 1.12. And after those 3 years, 3 years later, that dollar is now worth $1.40.4, right? Isn't that pretty cool? So, to go back to that question I asked beforehand, would you rather have a dollar now or a dollar at the end of 4 years or 3 years? You can see why you'd rather have the dollar. If you have the dollar now, you could invest it, and that dollar now would be worth $1.40. If you took the dollar in year 3, it would only be worth $1 here, wouldn't it? Okay, so this here shows us the future value of an amount. So this shows us the time value of money and how important it can be. So it's always a wise thing for a company that has a lot of extra cash sitting around. If it's idle, it's very important to have cash be productive, right? So it's important that you have enough cash that the company has solid liquidity, right? The ability to pay back those current liabilities as they come due, but also we want to make sure we don't have so much sitting around. If we have a great excess of cash sitting around, it could be doing something else productive, and that's what we want to make sure we're doing with it. And we've seen right here, if we were to invest that, it could actually have grown by 40 cents on the dollar, so that's pretty cool. Let's take a look at this. It says on January 1st, 2010, what is the present value of $1.44 to be received on December 31st, 2012, assuming an interest rate of 12%? To determine the answer, we need to go to Exhibit 1, which is on the next slide, and find the table value for 3 years at 12%. Let's take a look at this. So remember, we said 3 years and 12%. If we find where those two intersect in this table, these are in the back of the accounting book, right? So look in the appendix in the back, and we find this number 0.712. So if we had 0.712 and we multiplied it by the 1.404, that would give us $1, right? So let's skip back and look at this. So it was $1 that became worth $1.44, right? So let's take a look back again here, and this shows us the present value. So the present value of $1.40 with the extra 4 there is, if we multiply it by this number here, it gives us $1. So this keeps us from having to do all these calculations. And imagine how difficult it would be if it went on and on and on and on and on for maybe 20-something years. If we can understand how to use these tables, the present value of $1 at compound interest. Make sure you're using the right table. And if we understand how to do these tables, we can look at the year, we can look at the interest rate, we plug this number that it tells us to use in, because some poor schmuck had to sit down and figure all this stuff out, right? At some point in time, somebody did, and they did that, so why should we have to go back, reinvent the wheel, or do it the very slow way? The smart way to do this, we want to work smart and not hard, and the smart way to do that is to understand how to use one of these present value of $1 tables here, okay? Now let's talk about what an annuity is. An annuity is a series of equal net cash flows at fixed time intervals. The present value of an annuity is the amount of cash needed today to yield a series of equal net cash flows at fixed time intervals in the future. Now, it's the amount of cash. Remember, it's equal, right? It's equal net cash flows. So this is when we're talking about the same dollar amount. So it would be like having a 10 one year, 10 the next year, 10 the year after that, and so on and so forth. It can be thought of as the amount that you must invest today at a specific interest rate so that when you withdraw an equal amount of each period, the original principal and all accumulated interest will be completely exhausted or used up at the end of the annuity. So let's see here. Now we have to make sure we're using the proper present value tables because it makes a big difference if you're looking at the present value of a dollar or the present value of an annuity. Okay? So let's take a look here. It says the present value of $100 annually for 5 years at 12% could be determined by using the present value factor in this next slide. Let's take a look. Anyways, what we have here is we have $100 here, $100 here, $100 here, $100 here, and $100 here for each of these 5 years. So we're going to figure out what is what would somebody have to give us today at 12%. Well, let me just read this because I have it all phrased perfectly. If we invested $360.50 at 12% for 5 years, we could receive $100 per year and have zero left at the end of the 5 years. Okay, so let's take a look here. So the present value here of this first $100 is $89.30. For the second one, the present value is $79.70. If somebody gave us $71.20 after 3 years, assuming this interest rate, it would be worth $100. Another way to phrase it is just the same way like this. If somebody gave us $63.60 now, after 4 years it would be worth $100. If somebody gave us $56.70 now, after 1, 2, 3, 4, 5, it would be worth $100, right? So let's learn how to use this table. See, it's very important that we know if we're looking at the present value of a dollar or the present value of an annuity of $1. Okay? So we're looking at 5 years is what we discussed, and 12% interest is what we were given, and this is the number we come up with. So if we multiply 3.605 times 100, we get $360.50. So $360.50 now is equal to, we could get $100 each of these periods, and when we were done, it would be completely exhausted. We have zero left at the end of those 5 years. Now that we have a loose understanding of the time value of money, let's talk about this first method that uses it. Now there are other methods that are out there. In this book, however, we only had time to cover 4 of these. The net present value method is the first of those 4 that uses the present value concept. Remember, the first 2 did not, and this is the third one, and it's the first one that does. So the net present value method compares the amount to be invested with the present value of the net cash inflows. It is sometimes called the discounted cash flow method. So let's take a look here at some information and let's work a problem together. So it says, assume the following data for a proposed investment in new equipment. The investment costs us $200,000. We're going to be able to use it for 5 years. The company has a minimum desired rate of return of 10%. Okay, so 10%, that's what they want to make. If it earns, if we think it's going to earn less than 10%, we're not interested in messing with it. Okay, that's the minimum desired rate of return. The expected cash flows to be received each year, we have $70,000 in year 1, $60,000 in year 2, in year 3, $50,000, in year 4, $40,000, and in year 5, $40,000 as well. So the total expected cash flows, all these added up, are $260. The present value of the net cash flow is computed by multiplying the net cash flow by the present value factor of $1. Okay, we can't use the annuity table because all of the amounts are different each year. If it was 70, 70, 70, 70, 70, we could use the annuity table, but unfortunately, we're going to have to do this a little more slowly because each of these is different. Now, these last 2 are the same, but everything else is different. So $70,000 times that present value figure we're given there, okay, where N is the number of years and I is the interest rate. So if we had $63,630 and we could earn 10%, after year one, it's going to be worth $70,000. This amount here, after 2 years at 10%, is going to be worth $60,000. This amount here, $37,550. After 3 years at 10%, it's going to be worth this. We would have $40,000 if we invested $27,320 at 10% interest, right? We would have earned $40,000. And after 5 years, $24,840 would be worth $40,000, assuming a 10% interest rate, right? And that's also assuming that the interest is going to be compounded annually. So if we added up the present value of all of these, we get the present value of the cash inflows is $202,900. And how much did it cost us? It cost us $200,000. So we have a present value, a net present value, net meaning these two numbers are netted together, of $2,900. The equipment should be purchased because the net present value is positive. Now, if we have multiple pieces of equipment that we're considering, we'd want to choose the one with the highest net present value. The internal rate of return, or IRR method, uses present value concepts to compute the rate of return from a capital investment proposal based on its expected net cash flows. And this is the last of the 4 different methods that we're going to learn about in this class. So the internal rate of return is a rate of return promised by an investment project. Okay? The higher the internal rate of return, the better. So when we start calculating the internal rates of return, it's important to understand that if the internal rate of return is equal to or greater than the minimum required rate of return that a business might have, the project is acceptable. If it is less than the minimum required rate of return, then it's rejected. So we're going to take all the ones that are acceptable and look for the one with the highest internal rate of return, and that's quite possibly going to be the one that we're interested in undertaking. Now there's a trial and error method of calculating the internal rate of return that is extremely time consuming. So we're going to take a look here at a simpler method here. And so assume that management is considering a proposal to acquire equipment costing $97,360. The equipment is expected to provide an equal annual net cash flow of $20,000 for 7 years. Now we can only use this simpler method if we're going to have equal annual net cash flows. If we are not going to, unfortunately, it's going to require the trial and error version of this method that's extremely time consuming. So the first thing that we need to do is determine the present value factor for an annuity of $1 as follows. And we do that by saying the amount to be invested divided by the equal annual net cash flows. Remember, we're going to get $20,000 for each of those years for 7 years. And remember, we were considering a proposal to acquire this equipment at $97,360. So step 2 is to find the 7-year line on the present value of an annuity of $1 table. We're going to proceed horizontally across the table until we find the present value factor computed in step 1. So this is pretty easy. So we know we're dealing with $7. We calculated this 48.68 right here, didn't we? So we say, okay, 7 here, let's come across to 48.68, and we're not sure where we go next. Let's just look straight up, and 10%, okay? The internal rate of return is 10%. So remember, if the internal rate of return is equal to or greater than the company's required rate of return, then the project is going to be acceptable. Let's take a moment here and I'll prove to you that this works out. So if we had 20,000 annual net cash flows and we multiply it by this, we would have gotten this from the table, the present value of an annuity for 7 years. We'd get 4.868. If we multiply 20,000 times that, we get $97,360. That's the present value of the annual net cash flows. How much did it cost us? $97,360. That's the cost of investment. and so our net present value equals 0. Another way to think of the internal rate of return is as the discount rate that will cause the present value of a project to be 0. So in this case, the internal rate of return is 10%. So we're going to compare that to the internal rates of return for the other proposals, and whichever one has the highest internal rate of return will quite possibly be the one that we're going to use, the project that we're going to involve ourselves with or undertake. Feel free to pause your screen for the next couple slides if you want to take a second to read them. Okay, there's several more factors that complicate the capital investment analysis. Income taxes, that's a big factor right there, okay? And sometimes, many times tax laws are different from financial accounting rules. And although we don't have to follow financial accounting rules or generally accepted accounting principles under managerial accounting, a lot of times those are still some of the numbers that we might be using, okay? Sometimes the proposals are going to have unequal lives. Maybe we want to lease something instead of purchasing it. All sorts of uncertainty, changes in price levels, and also qualitative or considerations that cannot be summed up in dollar terms, like maybe the product quality. Thanks for taking the time to watch this video. If you have any questions, please let me know, and have a wonderful week.